and I think some of those problems are coming home to roost, that sort of missed opportunity. And so it's possible that we haven't really sort of had the full kind of cycle boom and bust in quite the same way as we did last time. It's amazing, the quality of life that we have now. Medieval kings couldn't ever dream of being able to do what we can do. But why is it that we have these periodic booms and busts? And why is it that when we get them, equality or inequality gets wider and wider? It shouldn't be like this. Really, the real tragedy of it all is that we spend all this time taxing people their, hard work. The more they work, the more tax they have to pay, and the more risk they take in business, the more profit they make, the more tax they pay. They're adding value, and you're taking it away from them. When the land market turns down, what happens is the central bank will reduce interest rates. That won't work, or it'll calm things down for a bit, and then suddenly some other problem will explode. They'll try and deal with that, and then it'll calm down. And it goes in successive waves. They're scratching their heads and they don't really know what to do. And this is why we get sort of really massive panics and so on, because it's clear that they aren't actually in control of the economy.
Hello and welcome to the MoneyMagpie Invest podcast. I'm Jasmine Birtles, founder of MoneyMagpie.com. Before we start, remember to subscribe, like, comment. Definitely comment, because I always look at those and I always reply. And also remember that nothing that is said in today's podcast should be taken as financial advice. It's just financial information. Right, got out that out of the way. Now, my guest today is Akhil Patel, who is a financial cycles expert, and he's also co-founder of Property Share Markets Economics. Hello there, Akhil.
Hi, how's it going?
Good, thank you. Well, I'm really fascinated to have you because I've had a look at your website and your book as well, all about financial cycles, and I'm rather fascinated at the fact that you've put a quite specific number on the number of years that financial cycles happen. It's 18.6 years. How did you work that out? And is it true? Is it really true? 18.6?
Yes, I mean, if you look at the average of the 18-year cycle in history, it comes out at sort of actually very close to 18.6 years. So yes, it's true. And as we do with our subscribers, we use that to kind of forecast the main moves in the economy and the stock market and other markets. And you can use that sort of insights to, run a portfolio or manage your affairs in a way that I think will, help you profit during good times and stay safe during bad times, which I think is really what it's all about. I should add that I don't only look at the 18.6 year cycle, but that is the dominant one because it affects the economy so impactfully. So I think it's the one that if you don't believe in cycles, or if you can only have the headspace to look at one thing, that's the thing that you should look at.
Well, it does seem to me that history is full of cycles, all kinds of cycles.
Yeah, that's right.
Different people say different amounts. I mean, when I was saying, is that true? I guess of course you're not going to be lying, but I was sort of thinking, how can you justify that figure? Because as I say, I've heard different figures from different people, and it seems to me that cycles tend to be shorter or longer. It's hard to get my head around the idea that there really is this actual figure that we could work with.
I mean, it's really good questions. I mean, actually fairly advanced in some ways. I mean, there are many cycles. I mean, you look at nature, there are short-term kind of mating cycles, the annual cycle or whatever. There are longer-term cycles. Crickets appear at certain times of the decade, et cetera, et cetera. So there are many, many cycles. They do sort of coalesce or fit within each other in many ways. And I think that's how I look at cycles in financial markets. So there's a very strong decade cycle, there's a very strong 30-year cycle, and so on. The 18-year cycle, however, does affect the economy much more significantly, particularly at the end, than other cycles. And so when that is turning down, other cycles fit within that, and they may have an effect, but not to the same extent as the overall kind of drivers that are driving the 18-year cycle. I mean, maybe I should explain to your listeners kind of what it is. It's essentially an 18-year cycle of boom and bust, typically kind of 14 years of boom, or it's not entirely boom, it's not boom in a straight line. It's often interrupted halfway through that 14-year period by a mid-cycle recession or slowdown. It completes the 14 years up after that, and then you get a major financial crisis. And so if you look at the historical record, it's not that you can suddenly sort of just discover it. If you look at history, it's where cycles are apparent. You can see that actually every 18 or 19 years, sometimes the cycle might stretch a little depending on specific policy changes or new fashions or new kind of events that are taking place. But it's pretty regular. You look at the historical record, you see that every sort of 18 years or so, there is a major financial crisis. There's a big kind of reset and the cycle starts again. So we're currently coming towards the end of an 18-year period, or I should say the 14-year period within the 18-year cycle. If you look back at the last major financial crisis in 2008, started in 2007, that was 18 years ago. If you go back 18 years before that, you had the major recession and banking crisis of the early 90s. People don't really remember that. It's one of the reasons why these cycles persist, is people don't really understand history or sort of know how to read it in the right way. If you go 18 years before that, you get to the kind of early to mid 1970s. You had the oil shock, but actually that was primarily a banking, financial, property cycle downturn, and the oil shock exacerbated that. If you go back before the Second World War, and the only thing that has interrupted the 18-year cycle in history has been the two world wars, you get the Wall Street crash of 1929, the Great Depression. If you go 18 years before that, you're into the banking crisis and bankers' panic of 1907, and so on. And you go back throughout history to in America, you can trace it back to about 1800. In the UK, you can actually trace it back longer than that, but the historical record is not quite so clear cut. In America, you can kind of see it very clearly because they started selling off the public domain from 1800s. And that created these sort of 18-year cycles of boom and bust. In the UK, history is a bit more messy. We had the dissolution of monasteries, you had sort of the privatization of the land market, and the cycle started to emerge. But of course, it really became apparent after we started industrializing a few hundred years ago.
And you were talking about the 14-year cycle. So you've got a 14-year cycle of, as you say, not completely in a straight line, but relative prosperity. And then you've got your 4 and a bit years of problems. And it looks like we're at the beginning of the 4 and a bit years. Is that where you're seeing us at the moment?
Yeah, I mean, I sort of fairly consistently for the last decade said that we should expect the peak of the cycle to be around 2026. That doesn't necessarily mean that the crisis starts immediately. Usually there's a period where things are slowing down potentially, or you've reached the peak in the land market. So I should have probably said when I was talking about the 18-year cycle that it's primarily driven by what's going on in the land market. Now we know about the land market because we're always talking about property, but when property is rising in value, it's not the building that's appreciating in value; it's the land on which the building sits. So it's essentially a land cycle, and land is it's the fundamental factor of production. Everyone needs a bit of land to occupy, to work, and to play, and so on. Most of what the banking system does is extend mortgages to people to acquire land, or to businesses to purchase land. Much of the valuation of any stock market is got something to do with land or natural resources. When I talk about land, I mean anything provided by nature. So natural resources counts. So it's, the value of and the importance of the land market is everywhere. And so we have a period when the land market potentially has peaked 14 years after it had its low. But that doesn't mean that, things can't continue going on for a bit of time before you get the major kind of crisis. So the peak I'm expecting sometime next year. Whether we get the crisis straight away or it takes a year or two to unfold, I think remains to be seen. It probably depends a little bit on what's going on, how much stimulus governments are pumping into the economy, et cetera, et cetera. And you might not necessarily see it unfold in the same way as we got during the 2008 financial crisis. It may be triggered in a slightly different way. I mean, if it happened the same way every time, I think everyone would see it quite clearly.
Well, quite. And the way you're talking about it, it almost sounds like, winter's followed by spring, spring's followed by summer, summer's followed by autumn, almost like a sort of a natural thing. And yet it's man-made. And we've had various governments going, we're going to stop the boom and bust.
Exactly.
Boom and bust. What's causing it? What is it? It's us clearly that are doing it. As you say, it started particularly with industrialization here. So what is it that we're doing and we keep doing that's creating this not very helpful thing? I mean, I think there are good cycles and bad cycles. These don't sound particularly helpful to us.
Well, they aren't when they turn down. Obviously, if you bought property in 2010, I think you'd think by this point the cycle has been incredibly helpful. Because it appreciated for the last, almost decade and a half. So, I mean, to a certain extent, cycles are natural, and I think we have this sort of slight conceit that we've dominated nature and that we're not sort of bound by it. I think human beings exhibit sort of cyclical behavior as well. I mean, well, naturally we do. I mean, we're very much affected by the annual seasonal cycle. We also have our own cycle in life. We're born, we grow, we come to adulthood, we get old, and eventually, unfortunately, we die. That's a cycle. So we are, cyclical beings, if you want to say it in that way. And apologies for getting a bit philosophical about it. In relation to our economic decision making, I think the first thing to say is that we all respond to incentives. I think Charlie Munger said, if you want to explain, I mean, I'm obviously butchering his quotes, but if you want to explain what's going on, just show him the incentive, because human beings will respond to that. And one of them is that, we're all, to a certain extent, whether we like it or not, investors. We make decisions accordingly in terms of what's going on. And the reason why the land market is so important to an investor is because, I mean, I've explained how it's effectively embedded in a lot of portfolios, whether you know it or not. But also, it's a essentially scarce asset. Land, there might be plentiful land, but land in the right location, where people live and work and, where you want to set up businesses, is incredibly scarce. And we know that very much. I live in London. You can see that very much the case. And so because it's a scarce asset, it's not produced.
Hi, I'm going to quickly interrupt this amazing podcast to let you know that Money Magpie Invest has a bi-weekly newsletter where we share tips, tricks and insights to help you become a more confident investor. Our newsletter is completely free to sign up to and it will arrive in your inbox on Saturdays at 12:30 p.m. As well as all of the super useful investing information, we also share exclusive deals from our partners. So if you're serious about building long-term wealth for yourself, I really recommend signing up. And you can find the link in the description of this podcast.
It has monopoly pricing power, appreciates in value. It attracts capital for that reason. It can go way over the top, as we've seen. Its valuation can then correct, but when it corrects towards the end of the cycle, it affects the banking system. Credit dries up. That affects what money is available for businesses. That reduces spending, etc. And also, high land prices are reflected in high property prices. A lot of money servicing mortgages, a lot of money going towards rents, and so that squeezes households, so they have less money to spend, which induces a recession. So we respond to those incentives. We exhibit these. We like to make money. We speculate. It goes over the top. It goes too far. It comes crashing down. And then it resets, and it resets at the same time. And it seems to be that 20 years or 18 years is enough time for us to really forgotten the lessons of the last crisis. Now, you might say, well, we all remember the 2008 crisis and so on. But I mean, if we were really honest with ourselves, have we done anything differently this time around? I mean, maybe some people have, but as a collective, I'm not really so sure. It seems to me that and I've been tracking this particular iteration of the cycle now since the start. In my book and in my business partner's book, we have things to look out for at different stages of the cycle. He's got a property clock in his book. I've got at the end of each chapter in my book, dealing with each stage of the cycle, I say, here is what you should expect at this stage of the cycle. And I think we've sort of tracked it, if I may say so, almost like clockwork. So whether it's sort of demographic, generational, kind of historical memory kind of reasons, I think they all coalesce into causing this sort of repeat of behavior that we've seen before. And of course, it looks slightly different. The economy now is very different to the economy in the 2000s, which is very different to the economy in the late 80s and early 90s.
But you've still got the cycle, even though it looks different.
Got the cycle, yeah. It's been going on it started in the US in 1800, as I mentioned. I mean, that was a sort of a backwater. It was, it had lots of land, but, it was very much subservient to European powers and much smaller and so on. It was an agrarian economy. But you got the cycle, and it persisted as it became this big industrial economy, and it persisted as it became this global superpower. And the same thing has been the case in the UK, as it's gone from industrial power to global empire to where we are now. It continues.
So you've got instructions for people as to how they can do well in both the up and the downside.
Yeah.
What are your basic pieces of advice for making the most of the upside and then defending yourself in the downside?
Well, everyone who's ever been involved in property has this sort of phrase, "If only I'd bought then." And then you need to know when then is, and then is usually the time when it's very difficult to buy, or very emotional, or you just can't, you don't have the money, or you can't get the bank loan, et cetera, et cetera. So the key thing is to understand the cycle, get in early, know that actually there are many opportunities during the upswing. I mean, I talk about how the stock market low, and then the start of the bull market often begins with tech stocks leading the way, the new technology that's going to power the new cycle forward. You'd say that, companies like Apple and Google, in the smartphone and all of that, which has fundamentally reshaped the economy this time. It's not the only technology that has, of course. But I think if I were to pick one thing that drove the current cycle into the new age, it was the introduction of the smartphone, interestingly in 2007 at the peak of the last cycle. But it was when everyone got onto 4G, I think, it was around 2011, wasn't it?
Yeah.
That's really what kicked things off. So you can, there are different sort of ideas at different stages of the upswing, but, get in early. Sort of you don't need to do anything too extravagant to make a lot of money if you are prudent and the timing is good. You can do very well. The key thing then, of course, is not to get carried away as you get into the mid-cycle slowdown. So we're talking about 2018, 2019, 2020. And we can come back to, what the mid-cycle slowdown was like this time around, if you would like to. If you are sort of caught in it, don't panic, because you will get the second half of the cycle. And then as you get close to the top, as things get frothier, as markets are in all-time highs, you start to, dispose of assets, start to build a cash pile. Doesn't mean you have to be all in cash or anything like that, but, start to have some reserve, because when you do get to the peak in the crisis, of course, you want to be ready to pounce on what are much better and more favorably priced assets. But of course, if you've got into difficulty, if you're over leveraged, if you can't service your debts, then you're in trouble. And I think the key thing about the 4 years down is, in addition to having the opportunity to buy things at a low price, the key thing is, I mean, you might be fully invested, but what you don't want to do is be forced to sell something in a downturn. And often you're forced to sell because you have obligations to your bank or to other people, which you can't meet out of your current income, which might be reduced. So this is why it takes a bit of planning. And if you can't meet them, then you have to start to sell assets that you really don't want to. And of course, you're not going to realize their value because it's a downturn. There won't be as many buyers, etc. So you've got to avoid that. That is the thing I think that ruins people. Even if you bought in towards the top, and I call the final 2 years of the cycle, I call it the mania in my book, but another name for it that we've given is the winner's curse. You're competing with everyone to buy these assets which you think are doing phenomenally well and will be appreciating and so on. And of course, you're buying in close to the top. Even if you've done that, but you can ride out the downturn, I think you'll be okay. But if you can't, you're in serious trouble potentially. It might take quite some time to recover.
And you're talking about property, shares, bonds. You're talking about all types of investments.
Yeah, I mean they behave. They don't all behave in exactly the same way throughout the course of the cycle. Of course, the stock market has periods of extreme euphoria, and it comes down quite hard. But typically, the main down moves in the stock market coincide with either the mid-cycle or the end-of-cycle recessions. Commodities have a longer-term cycle and shorter-term cycles, and of course, each commodity is slightly different and has its own peculiar supply and demand factors, and are increasingly shaped by what's going on in the international space, competition between China and the US and other countries, and wars and so on. But the general trend of commodities tends to be that when you get the second half boom, commodities tend to appreciate, particularly things like industrial metals and to a certain extent precious metals, partly because there are concerns about inflation or the health of the financial system and so on. And that becomes very apparent when you get to the crisis.
So I'm guessing that we're as we're coming into the down 4 years of downwards, that precious metals particularly are going to do very well for the next 4 years or so. Would that make sense?
That's my expectation. We don't have, you're talking in particular about gold. I mean, until 1971, the price was fixed, so we don't have very long-term history. And if you're a cycles person, you want to see hundreds of years of data so you can spot these things. But it does appear, so the late 1970s, which was the kind of 4-year sort of crisis period then, and certainly the years after 2008, that gold appreciated very rapidly, partly because that's where a lot of investor capital was going, with the expectation that the financial system might come crashing down, or it's irrecoverable, and also concerns about inflation to do with stimulus. Now those concerns were unfounded, which is probably one of the reasons why gold came down quite hard in 2013. I think it was the start of 2013 when it really kind of had a crash. But you would expect this time around that sort of pattern to repeat, that it would continue going up during the crisis period. Now, it's not up in a straight line, and actually, if you look at the gold price in 2008, it fell quite hard, in a very swift fashion, partly because probably people had to liquidate some of their positions to make good on other obligations, margin calls and other things like that. But then it recovered quite strongly into 2011. And I expect something similar.
When it comes to property, again, you've got governments that are tinkering, because to my mind, property should be a lot cheaper than it is, but it's being held up artificially by governments, and has been for all of my life. Well, I was going to say no, maybe since the 80s particularly. So do you see that these cycles being messed around with by government, or do the cycles ultimately override even government tinkering?
I mean, it's a good question. I th- so governments are part of the economy. I think we sometimes think of the central bank and governments as sort of sitting on top and managing things and pulling the strings. Of course, I mean the number of times they claim that they've sort of ended the business cycle, and it doesn't. It's not just Gordon Brown. He's just the most prominent recent example for your UK listeners that they'll be familiar with. But it's been going on, as long as there've been politicians and the cycle, as it were. Yeah, I think the reality is that in our current sort of economic system, when governments have run out of ideas as to how to grow the economy, the one thing they can do is prop up the property market. It's a good way to induce construction. Construction is a big part of an economy. It's a good way to get people feeling like they're wealthy because they've bought property. So that you help them with deposits, or you help them with sort of stamp duty relief and other things. You can sort of artificially boost the economy in that way. And that is the go-to policy that people have been resorting to across the Western world in the last few years, partly because housing and getting onto the housing ladder is such a hot button political issue. So I would quite agree that they have propped up the property market. Having said all of that, it does seem to be the case that it's one thing that we've noted looking at the cycle historically is that, in particular, the second half of the cycle involves a lot of capital investment by the government, a lot of infrastructure building, repairing the roads, support, spending on defense, which often involves jobs in lots of different kind of parts of the country. Building schools. I think and hospitals. This was really big in the last cycle. And one of the effects of all of that infrastructure spending is to indirectly prop up the land market, or prop up or boost the land market. Now, we're all quite familiar with that. We know that when what's happened to property prices around the stations along the Elizabeth line, for example, it's had a massive boost to existing landowners, property owners. So this is basically the cycle in operation. It's government spending money, whether it's directly into the property market or it's via the infrastructure or other things, has results in the property market getting overheated, going too far, and eventually coming down. So they can't override the cycle, that's for sure. When the land market turns down, what happens is the central bank will reduce interest rates. That won't work. Or it'll calm things down for a bit, and then suddenly some other problem will explode. They'll try and deal with that, and then it'll calm down. And it goes in successive waves, and they're scratching their heads and they don't really know what to do. And this is why we get sort of really massive panics and so on, because it's clear that they aren't actually in control of the economy, and people are flying to safe assets. It used to be the dollar. Maybe next time it might be something else, but that's kind of how it unfolds. So government's very much part of the cycle, not above it.
That does seem to be the way it feels right at this moment. I think, generally speaking, there's very little confidence in the current government, in the current Chancellor, current Prime Minister and his group of advisors. So you could say that it's not entirely their fault, that they are hostage to fortune right at the moment.
Yes, we should let them off the hook. I suppose you could say that. I mean,
I wouldn't.
yeah, yes, exactly. I was just how should I answer this? Look, they are. I mean, look, I think they give the impression that they know what they're doing, and this is not a point against the current government. I mean, in every government coming towards the end of the cycle, or starting the cycle, they gave the impression they know what they're doing, and they do signal to people how to, what economic decisions to make, and they also influence how to make them through the tax system and so on. So I don't know if I would give them too much of a pass, because that sort of feeling that they're in control and then influencing people's behavior often leads them to making very bad decisions. I think one thing I would say though, and I have talked about this in my book, is that there is a solution to this boom and bust cycle. It's been known for well over 140 years. All this kind of talk about how there's no money and the government can't afford this. I mean, it's all nonsense. It really is. So and governments, I think people in power and politics, there's probably enough knowledge of how to solve the problems, but there's just not enough votes or or there's a lot of vested interest against solutions like this. And they're not brave enough or powerful enough or whatever to enact them or honest enough to talk about them.
So what is the solution?
Well, so there was an American economist in the 1800s called Henry George. He wrote a book called Progress and Poverty in 1879, and it for the 30 years after that, it became the most widely read book in the world, apart from the Bible. And influenced all sorts of people like Churchill and Sun Yat-sen and Tolstoy and various people. It launched movements and so on. Probably still is the most widely read economics book in history, but no one's heard of him now. And he said, he was looking at the very rapidly industrializing American economy and saying, it's amazing, the quality of life that we have now. Medieval kings couldn't ever dream of being able to do what we can do. But why is it that we have these periodic booms and busts? And why is it that when we get them, equality or inequality gets wider and wider? It shouldn't be like this. And he wanted to find out why. And he identified the causes being within the sort of land market, and land being the ultimate speculative asset, and it going over the top. And when it comes down, it brings the entire economy crashing down. And he said the inequality was down to ultimately the inequality in distribution of land, ownership of land.
Yeah.
And he said, really, the real tragedy of it all is that we spend all this time taxing people their, hard work. They, the more they work, the more tax they have to pay, and the more risk they take in business, the more profit they make, the more tax they pay. They're adding value, and you're taking it away from them. And yet you have this entire kind of class of landowners who the value of their land has got nothing to do with them. It's down to the value of public investment, because that's what gives location its value. It's all the roads and the bridges and the ports and the housing and the parks and so on, which makes a location valuable. We just talked about what happens when you build a rail station connecting you to the center of the city. All the property prices go up. So that incremental value is what should be returned back to the public to as a compensation for an investment, and then that should be redistributed to people. And if you did that, you would eliminate the incentive to speculate. So you wouldn't get these sort of booms and busts, and it wouldn't, the land market wouldn't come down so hard, and it wouldn't bring the banking system down. And also you would return all this public value back to the public, and you would stop taxing work, and you would stop taxing business risk.
That's amazing, to stop taxing work. And just as you say, it would take a lot. It would take a lot of strength, a lot of bravery, and a refusal to be pushed around by the voters as well as your own party to actually implement that.
Well, so interestingly, the Liberal Party, now we're getting some maybe slightly off topic for what your listeners are thought they'd be hearing about, but the Liberal Party in 1909, and by the way, this was Churchill at the time was a Liberal MP, and this was very much something he championed. Yeah. It's very interesting. This kind of knowledge about Churchill is kind of lost to our collective memory. They proposed just this solution, but of course, at the time, and still now, but particularly then, the House of Lords was stuffed full of landowners.
Yeah.
And they were not supposed to block a money bill that had been passed by the House of Commons, but they did. And they managed to successfully fob it off. And then the First World War intervened. And after that, it never sort of really came back. And the Liberal Party essentially collapsed.
Big shame.
Yeah.
We could have had We could
we've
have
had
had
it.
a really serious change of thought, change of direction. Yeah, right.
Exactly. And I mean, there are some countries that have implemented versions of this, and the two most prominent sort of British related ones are Singapore and Hong Kong.
Yeah,
Hong Kong, partly because, of course, we were only leasing the land from China for 99 years. So you couldn't have the sort of freehold ownership. And it's well enough known about as a solution that they implemented there. And same with Singapore, collects a lot of its land rents and puts it into a massive sovereign wealth fund, which
yeah,
they have no arguments about, how much to spend on infrastructure and so on, or no money to kind of fill in potholes in the north of
yeah.
England and so on. I mean, it's kind of a ludicrous state of affairs that we've got ourselves into.
It is, and I'd love it if we had a sovereign wealth fund, like Norway has done with their oil. We just spent
Yeah,
our oil money.
we had the opportunity, and it
Yeah.
would have been even bigger than Norway's.
Yes, it would have been. It would have been fantastic.
Mm.
So, we've heard a lot about the cycles and the economics and politics. What about for individual investors? What should people be doing now? Where do you think that we are really properly in the cycle? So, what have we got to sell? What have we got to buy? What have we got to be aware of?
Yeah. So, I mean, first thing is read my book. So I may say
Yes.
that.
What? Give us the title of your book.
Yes, it's called The Secret Wealth Advantage. Here it is.
Ah,
So you can
great. The
see that.
Secret Wealth Advantage.
Yeah.
Excellent. I'll put a link
Um,
to it.
Yeah, that's very kind. Now, I mean, the reason I say that, I mean, in addition to, I like it
It's
when
your
it
book.
sells copies. Of course, it lays out, and I think in fairly easy to understand language, the entire cycle. You can, and I've divided the cycle up into stages.
Mhm.
Um, Interestingly, I'd start at the start, chapter 1, chapter 14. 14 years in is the peak.
Right.
Chapter 18 is the final chapter, so it mimics
Mhm.
the rhythm of the cycle as well.
Yeah.
So you can go straight to chapter 12 and 14, which deals with the sort of the final few years of the cycle. Now, what I advise in that, and what I advise to my subscribers at Property Share Market Economics, is that, look, at the moment we're in a bull market.
Mm.
Um, we are, it's fine to be invested, but just don't be overdoing it. Maybe think about, building, not putting more into the market, building up some cash for the reasons that I've said.
Mm.
Make sure that if you've got a stock portfolio, you're sort of clear on where you would exit if things start to come down, to preserve some of your profits. Um, if you have a property portfolio, it's an opportunity now to. I mean, it may be slightly late because I should say it's a global cycle.
Mm.
It's very much led by the US, but the timing is very consistent across the world. And uh, you know, we're in that sort of phase of the cycle now. It doesn't mean that every part of the world is going to experience the cycle in exactly the same way. And I think, to a certain extent, um, possibly given sort of the state of our economy, all the fighting we've done in after 2016 and the Brexit referendum. I mean, regardless of where you sit on that sort of decision, I think anyone would agree that we've spent the next few years arguing with each other as opposed
Mm.
to investing in the future, AI future, and so on. And I think some of those problems are coming home to roost. That sort of missed opportunity. Um, and so it's possible that we haven't really sort of had the full kind of cycle boom and bust in quite the same way as we did last time. And another example is Germany in the 2000s didn't really have much of a boom either. So it's possible that the experience within an individual country is slightly different. So I just say that because the news here has been sort of quite negative, as opposed to the news in the Middle East or parts of
Yeah.
America, or other countries which have really experienced a full-on boom. Anyway, that to say, if you've got a property portfolio, you might want to dispose of some of it. Realize the gains. Maybe it's slightly difficult. Maybe it's that we've missed the really best years to do that. But nonetheless, I think prices haven't come down very much on average. But if you've got good quality assets, just hold them. I mean, they'll be generating rents. Don't overthink the cycle. Just focus on quality. Build a cash reserve. I'd run sort of relatively tight stops on your portfolio. I mean, nothing crazy, but do that. Look to sort of assets that will probably do well in a downturn. We've talked about precious metals. I mean, typically, if you're exposed to the currency markets, typically, I mean, it's usually the dollar, the yen, the Swiss franc that do well in the downturn. Dollar, there's a little bit of a question mark around, but I think it's quite complicated. And everyone's sort of talking down the dollar, which kind of makes me wonder if it's actually the case that it's in such a bad situation. But say the yen and the franc should be havens. It looks like they are when there's been a bit of a blip. Yeah, I mean, I think if you've got any kind of assets which are purely kind of speculative, and when I say that, the value's got nothing to do with their sort of underlying earnings. If you've got a crypto portfolio with lots of stuff in it, other than Bitcoin and Ethereum, I would look at that quite carefully. Now, that's not to say they might not have a bit of a run as interest rates come down, as the dollar comes down, as the governments try and pump liquidity into the system. But just beware that when they come down, they're going to come down very hard, because not only do they do that anyway, but they haven't seen the end of the cycle crisis yet.
Right.
And so some of those things could literally go to zero overnight, I think. So I think be quite careful about that sort of thing.
And finally, really helpful advice as to what to do, now. But then there are going to be some really good buying opportunities. I'm guessing in 2-3 years, will there be?
Yeah, I mean, it sort of depends on the market. And so on. We may still be in the crisis. The stock market might still be coming down, but of course, if you're a value investor, you should be starting to see companies that you want to own at prices that you would be prepared to pay for them. So that is the sort of time, 2, 3, 4, 5. I mean, in any of those years at the start of the cycle, you should find some really good valuations and good prices. When the news is really difficult to buy, though. So that's kind of when I think you really need to lean on some knowledge of history and so on, to be able to do that. But you don't have to find the absolute bottom of the market. You just as long as you're buying relatively early in the cycle, I think you'll do well. So again, you don't have to overthink it. Just be prepared. Have some money. Be prepared to be able to jump in when things are sort of fairly low, even if you don't get in right at the bottom.
Great. So tell us the name of your book again. As I say, I will put a link in the bottom.
It is The Secret Wealth Advantage: How You Can Profit from the Economy's Hidden Cycle.
Very useful, very, very useful. This is something that I haven't done enough. I'm very much a buy and hold, but I need to be more of a hold until it's time to sell kind of person. So,
but at some point, you do need to realise your gains. But,
yes.
Again, and also bear in mind, I'm talking the macro picture. There are individual kind of dynamics within whatever sort of asset you're holding. You might find that you just get an amazing offer or something, and it's too good to be true, or you think it's the right time to sell, but you just can't find the buyers for whatever reason.
Yeah.
So, yeah.
Well, brilliant. Thank you very much indeed. This has been Akhil Patel, a financial cycles specialist. And this has been the Money Magpie Invest podcast. Remember to subscribe, like, comment, tell your friends you want to. And also, nothing that we've said today should be taken as financial advice. It's been financial information. Do your own research. And see you next week.